Hello everyone, let us begin the discussion. So in the first section we have seen that exceeded part. Okay, now we are going to the second part of the chapter, that is probability integral transforms. Okay, this is again for the model verification. Okay, means you want to check that whether your war model is reliable or not. Now this particular method is much more advanced, okay, to validate your war model. Okay, we call it as a PIT approach. PIT approach. Clear? Now, the first question is, why do we need PIT based best testing? Do we need why do we need PIT based backtesting? Why do we need PIT based backtesting? Now, till now we have seen accidents based backtesting. Okay, that was focused only on the tail of the distribution. Clear? Now, this particular approach, okay, it checks if the actual losses actually exceeds the VAR threshold. Clear? But it ignores the overall accuracy of the model across all possible outcomes. Means your accidents, it is focused only on the tail aspect, whether you have breached this limit how many times, whether you are expected that it will breach only 12 times but it breached say 18 times. Clear? But you are focused only on the tail side. Clear? Not on the overall accuracy of the model across all possible outcome. Clear? So this PIT approach, okay, it is different. Clear? So it does not only focus on the tail, okay, it checks if the entire predicted distribution is accurate or not. Are you understanding? Means exceeded works only over here. PIT approach works on the whole distribution, Clear? Imagine that you are throwing a dart at the dartboard. Clear? And if your aim is off, okay, sometimes you may hit the target, sometimes. Clear? But overall your accuracy is poor. Why? See, you are putting, this is the point you should target. Clear? And you are not the one who can target it properly. So sometimes it goes here, sometimes here, sometimes here, sometimes here. But there is a possibility that by luck sometimes it touches over here as well. Clear? But overall, if I look at your accuracy, it's going to be poor. Clear? So over here PIT comes, and that helps us to check if our war model consistently predict the risk correctly or not. Clear? I want my model to predict consistently. See, this accidents I have checked only in the extreme cases. Clear? Accidents works well in the extreme cases, whether my threshold breached or not. Clear? But PIT checks consistently predicts the risk correctly or not. Clear? Now, how to calculate this PIT values? So we are going to do 4 steps. Step 1. Forecast the distribution for the next day. Forecast the distribution. Forecast the distribution for the next day. Clear? Now, before the trading day begins, clear, the VAR model predicts the range of the possible profit and loss outcome. Clear? Means your trading starts at 9:15. Clear? So before that you identify that what is the possible profit today and what is the possible loss today. Clear? You have identified that. Clear? So model predicted that tomorrow's profit and loss will be normally distributed. Clear? And the mean is 0 and standard deviation is $500. The mean is 0, standard deviation is $500. So means it can go up as well as it can go down as well. Clear? Then we have step 2. Observe the actual profit and loss. Observe the actual profit and loss. Clear? Now market ends at 3:30. Markets ends at 3:30. Clear? Now you will check what is the actual PL. You will check what is the actual PL. Clear? Suppose the real profit and loss is negative $250. Suppose the real profit and loss is negative $250. Clear? Now, step 3. Convert the observation to a probability. Convert the observation to a probability. Convert the observation to a probability, or we can say it as a PIT value. Clear? So basically we can check where this profit and loss falls in the prediction distribution. Clear? And this is done with the help of CDF. This is done with the help of CDF. CDF stands for cumulative distribution function. Clear? Write down. The model predicted is normal distribution. With mean is equals to 0. Standard deviation is 250. But my actual loss is $250. Clear? And that is what? Equivalent to standard deviation of 0.5, negative 0.5 away from the mean. Clear? Now, for a normal distribution table, try to understand, this is a normal distribution table. Here is the mean 0. Clear? Now, you have come this side with SD over here is 0, over here is 0.5, and over here is negative, and this one is positive 0.5, then 1, then 2, and then 3. 1, 2, and 3. Clear? So U stands over here 0.5 standard deviation, because you see how much it actually moved from 500 to, from 500 it ed only 250. That means it moved only half. So your standard deviation is negative 0.5. Clear? So based on that we will see the movement. This part, how much it actually moved. Clear? So we identify based on the table. We'll go to the table, and based on this value we have identified that the probability is 30.8%. Clear? Write down the statement, very important. We find that 30.8% of observations are at or below negative 0.5 standard deviation. Clear? So with this probability I got the standard deviation. So what is the PIT value of the day? PIT value of the day is 0.308. Clear? So this is the step 3 where we have identified the PIT value. Clear? Coming to the step 4, analyze the PIT values over time. Analyze the PIT value. Analyze the PIT value over time. Analyze the PIT value over time. Now we repeat this process every day. We collect the PIT value over time. Clear? Now if our war model is correct, then PIT value should be point number 1. If our model is correct, if our model is accurate, then PIT values number 1 is uniformly distributed. That means the value of the PIT will be between 0 and 1. Then independent, that means no clustering, no pattern. No clustering and no pattern. Clear? Then we have point number 3, consistent with the expected exceedance probability. Means how many time you are actually exceeding the threshold, that also required. Clear? You are calculating the PET, so it should be normally distributed, and it should be independent, and it should follow the rule of exceedance as well. Clear? Now the point is Now the point is how PIT helps, how PIT helps validate a VR model. Validate a war model. How PIT helps validate a war model. See, once we have a time series of PIT, means on a daily basis you have the value of PIT, so we call this as a time series because for every day you have the value. Clear? Now we analyze their distribution to test the war model. Clear? So you have the daily data, suppose it's of 252 days data. 252 days data, you have already analyzed it. Clear? Now you analyze their distribution. You analyze their distribution. You analyze their distribution to test the war model. To test the war model. To test the war model. So first what you will do, you will check the uniformity check, basically unconditional coverage test. What you will do? Unconditional, write down unconditional coverage test. Unconditional coverage test. Now basically we are doing the check of uniformity. Clear? Now write down, if the war model is correct, then PIT value should be evenly spread. Then PIT value should be evenly spread between 0 and 1. Between 0 and 1. Clear? If we see too many values, either close to 1 or close to 0, clear? That means my model either underestimate the risk or overestimate the risk. My model will either underestimate the risk or overestimate the risk. Clear? If the PIT values are mostly between 0.2 and 0.8, if PIT values are mostly between this, then the model is too conservative. Write down, the model is too conservative. Too conservative. Clear? And if the PIT values are either close to 0 or close to 1, then model is underestimating the risk. Underestimating the risk. Clear? So over here it's too conservative. They have overestimated the risk. That means they have kept good amount of capital for the reserves. Clear? Because they have overestimated the risk and they're trying to be conservative. So first thing what you will check is unconditional coverage test, basically the uniformity. That means how the values are distributed. Clear? So first thing which we have checked is uniformity. Now we have to check the independence. Clear? That means randomly spread over time. We need to check whether there is clustering or not. If there is a clustering, clear, this suggests that model is not well adjusted to the changes. Clear? So what we want from our model, that the PIT values are randomly spread over time. PIT's values are randomly spread over time. Clear? Write down, if high PIT values generally greater than 0.9, appears several days in a row, means on a regular interval you have seen that PIT is very high. Clear? PIT is very high. Now what does this interpret? Write down, this means that model is missing large losses. Model is missing large losses and needs adjustments. Clear? If very low, means less than 0.1, that too on a regular interval, that too on a regular interval, that too on a regular interval, and they appears repeatedly, this means that the model is too conservative, too conservative. This means that the model is too conservative and you need to recalibrate, clear? Point number 3, based on testing, conditional coverage test. Conditional coverage test. Basically, this combines the uniformity and independence test. If the model fails this test, this means that the war prediction do not match the real market risk. Clear? So let me summarize this whole part. Point number 1, accidents based backtesting only looks at the extreme losses, that means only on the tails, but the PIT based backtesting, it checks the entire distribution. Clear? Now second point, PIT values are calculated by mapping the actual profit and loss value to the model predicted distribution with the help of CDF. Third point, a good war model will produce PIT values which are uniformly distributed and independent over time. And the last point, the PIT values should not cluster, and if they cluster, they need adjustment to better reflect the market risk. Clear? Clustering should not be there. Got the point? Okay, so now we can start the second point, that is PIT distributions. Okay, give the heading PIT distribution and the war model quality. Clear? So till now what we have seen is what is PIT. We have seen that. Okay, and we have also seen that it is an advanced version of what we have seen before, because it captures the whole distribution. Clear? Now write down a question. What does a perfect war model looks like? What does a perfect war model looks like? What does a perfect war model looks like? See, imagine in a world where war model predict risk with 100% accuracy. Imagine, means this is definitely not possible, but I am saying imagine that your model predicts with 100% accuracy. Okay, it's 100% accurate. That means what? PIT value, this means what? PIT value, if it is correct, this means that PIT values are uniform between 0 and 1, and there is no clustering, Clear? So now what I can do, I can divide this PIT value in 10 groups, Clear? How I can divide? 0.0 to 0.1, 0.1 to 0.2, and so on, 0.9 to 1. So this is the way I have divided the values in 10 times. Clear? In 10 different parts. The whole PIT values are distributed in 10 different parts. Clear? Now what I'll do, everyone have a value, everyone will have a value. This means that within this range, in this range, how many times you have seen a PIT value? In this range, how many times you have seen a PIT value? Clear? Are you understanding? Now, so the value for them will be something like this. Means from 0 to 0.1, the value says 12. So it means 12 times it came. 0.1 to 0.2, again it came 12 times. Means it is uniformly distributed. Clear? So you have a straight horizontal line. Clear? In a probability distribution function. Now why this actually happens? Because the PIT values are truly random and they spread out evenly, means all the values are equal, that is 12 in all the cases. Clear? This means that our war model is accurately forecasting the probability of different market outcomes. Clear? that means what? Your model is perfect. But this is not the reality. Now the question is, what happens with an imperfect war model? Means now your war model is not correct. If your war model is not accurate, not 100% accurate, clear? So either it will underestimate the risk or it will overestimate the risk, clear? And your PIT distribution will start looking uneven. Means sometimes it will give the value low, sometimes it gives the high, sometimes it gives the low, sometimes it gives the high, clear? So this is an imperfect forecasting, clear? We call this as a imperfect forecasting, clear? Write down: the model underestimate the risk. The model underestimate the risk. The model underestimate the risk, clear? That means what? It predicts smaller losses than actually occurs, clear? If model is actually underestimating the risk, it predicts smaller losses than actually occurs, clear? In this case, your PIT values will cluster near the zero, over here, okay? Maximum values will stay around over here. Why? Because, write down, because the actual losses are larger than expected. So their PIT values are very low. Clear? If your actual losses is greater than the expected losses, then your PIT values are going to be very low, clear? And the opposite is the true. If it overestimate, then it predicts the larger losses. Means it's saying that your expected losses are greater than the actual losses. That means you are predicting that losses are way too high, but in reality you will get only small losses, clear? So it is predicting higher losses, it is predicting lower losses, clear? And your PIT's value is high and it will cluster around 1, clear? Are you understanding this point? Now write down hash using a QQ plot, to visualize model quality, to visualize model quality. Now, rather than looking at just a normal histogram, what we can do, we can compare the PIT distribution using a QQ plot, clear? So first of all, let us understand that what is this QQ plot is, clear? Write down point number 1. It compares two probability distribution. It compares two probability distribution. It compares two probability distribution. Write down second, the actual PIT distribution, from our war model, and write down third, the expected, or you can say perfect uniform distribution. So basically it compares these two. Number 1 is the actual means something which you have designed using the real numbers, and you will compare it with a perfect uniform distribution. Means you wanted model to be like this, but in reality model is like this. Are you understanding? And you will compare both of them, clear? So how it works? Write down how it works. We plot the cumulative percentage of PIT values, we plot the cumulative percentage of PIT values against the perfect uniform distribution, against the perfect uniform distribution. See, this is my perfect uniform distribution. This is my perfect uniform distribution, and my values are ranging like this, and my values are ranging like this. Clear? So what I have done, I have plotted the cumulative percentage of PIT values. This is the PIT value, and this is your uniform distribution, where value started from 0 to 1, where value have started from 0 to 1. Clear? Now, if the model is accurate, the plot should be a straight 45-degree diagonal line. If model is inaccurate, then you will see the curves and the bands. You will see the gap between the perfect and the imperfect model. Clear? So this shows that your model is wrong. This shows that your model is wrong and it needs improvement. Clear? Are you understanding? If suppose, I'll prepare one more. This is the expected. And suppose your line is somewhat like this only. That means your model is more or less same. But if it is like this, that means we need to work on our model. Clear? So write down, if curve is bending upward, if curve is bending upward, then it is underestimating the risk. Then it is underestimating the risk, where PIT values are close to 0. And if it is downward, it is overestimating the risk. Values are close to 1. Clear? This is your point number C. Clear? Now coming to the last LOS, that is evaluating the PIT distribution. Now, this is the most important aspect of validating a war model. Clear? Over here, you are evaluating the PIT distribution. Clear? Now, the point is, why do we backtest using the PIT? Write down the first question in mind. Why do we backtest? Using PIT? Clear? So write down point number 1. We ensure that the predicted risk distribution matches the actual outcome. Write down. We want to ensure that the predicted risk distribution matches actual outcomes. Second, PIT values are uniformly distributed between 0 and 1. PIT values are uniformly distributed between 0 and 1. Point number 3, PIT values are independent over time. PIT values are independent over time. Write down, backtesting with PIT tells us whether our war model correctly forecast market risk across all possible outcomes, not just the extreme losses. Clear? Write down second, goodness of fit test fit test to evaluate PIT distribution. To evaluate PIT distribution. Now, my point over here is to ensure that whether my PIT distribution is matching with the expected uniform distribution or not. Clear? I want to check that whether they are matching or not. See, sometimes you cannot visually identify that, but with the help of some test, definitely you can do that. Clear? So the first one is Kolmogorov Simonov test. Okay, let's take it KS test. This is the first test. Now, you don't have to do the test, but need to understand that what they are actually doing. Clear? So write down over here. The notes are very important. If you are preparing the notes properly, these things will become much easier for you. The KS test measures the KS test measures the largest vertical difference between point number A, the actual PIT distribution, and second is the ideal uniform distribution. Clear? So if you look at the graph, okay, let me plot it again. This is the one which you wanted, but in reality you have this one. Okay, this is the reality. Clear? Now you have calculated the distance, the vertical distance, this one. You have calculated the distance, the gap between the actual and the expected one. Clear? Now you want that red line to be closer to the black line, because then it is to be perfect. Clear? So what you want this D. Okay, you have calculated this value of the D with a formula. Okay, see, which you don't need to know, because no theoretical questions will be asked, but yes, it is calculated based on the CDF, the actual CDF, and the theoretical distribution. You have calculated the distance, and that distance is the test statistics, KS test statistics, and you want it to be lower. The lower the D, the better the model. The lower the D, the better the model. Clear? Because visually you cannot identify that how much close it needs to be, but based on the number, definitely you can check. Clear? Now we expect some time D will converge to 0. That means this black line and red line should be overlapping with each other. Clear? So first of all, we need to compute the test statistics. Clear? And once we have calculated the test statistics, then we can compare that how much it is, but that require lots of programming, so I'm not entering into that. Clear? But we got a good understanding. Clear? So write down, if KS test statistics is small, the model is good. If KS test statistics is small, the model is good, and if it is large, the model risk forecasting are inaccurate. Clear? Write down the limitations. Write down the limitations of this model. Write down limitations. The KS test treats all deviations equally, meaning it does not focus on large losses. Which are more important in risk management. So it treats all the deviations equally. It says that for me, all losses are equal, whether it is the loss of $10 or whether it is the loss of $10 million. Clear? Now coming to the second test, that is AD test, that is Anderson Darling test. Clear? Now this is also similar to your KS test, but it gives more weight to the tail observation. Means over here we have the limitation that we treat all the data equally, but this test give more weight to the tails, give more weight to the tails, the extreme losses and the extreme gains. Clear? So if your war model underestimates the extreme losses, the PIT value will cluster near zero. In that situation, the AD test will flag this issue more strongly than the KS test. Why? Because KS have evenly distributed, but it says that, see, I have checked in the tails and there is an issue. Clear? Now, if the AD test is small, model is good. If the AD test is large, then model failed to capture the tail risk accurately. Clear? And it is best for the risk management because it emphasizes on the large losses. Clear? Then we have the third test, that is CVM test. CVM test. CVM test. Clear? Now, what does it actually do? Clear? Now, instead of measuring the maximum deviation like the KS test or AD test, what CVM test actually do? It calculates the average squared deviation. Write down. This calculates the average squared deviation, average squared deviation between the actual and the expected distribution, between the actual and expected distribution. Clear? Now if my PIT distribution consistently deviate from the uniformity, then the CVM test will detect this. Clear? So if the CVM test is small, model is good. If it is large, model is not good. Clear? Now what's the benefit of this? Write down. Captures overall model captures overall model fit, captures overall model fit, and it is better than KS and AD test. Clear? Now we have to check for the independence in the PIT value. See, you have checked the uniformity, but PIT value independence is also important. Okay, so PIT value should be independent over time. If they are dependent, it means that the war model fails to adjust properly to the market changes. Now how you will check this interdependence? Clear? How you will check this interdependence? Point number 1, transform PIT value into standard normal values. Transform PIT value into standard normal values, that is 0 to 1 range. Mean is 0, standard deviation is 1. Clear? So this avoids the problem caused by the 0-1 range. This avoids the problem caused by the range of 0 to 1. Then use the log likelihood function. Use log likelihood function. Use log likelihood function to test for the independence. So if the transformed PIT, shows pattern, the model is not dynamically adjusting to the new risk. So if there is a pattern, that means it's not properly well curated. Clear? You need to make the changes to your model. And third is visual check. Visual check means scatter plot of the PIT, clear, versus the lagged PIT. Clear? If they are truly independent, then scatter plot will also look randomly spread out. But if you'll find clustering, it suggests that the past PIT influences the future PIT, which is a problem. Clear? So you need to test for the uniformity as well as the independence. Clear? So with this, we have completed our all three LOSs, and we have covered each and everything in detail with the most easiest possible manner. Clear? Okay, so I end this lecture here only. Thank you.